We grew revenue and margins sequentially while driving favorable mix and cost reductions amid ongoing global supply chain challenges. We saw broad-based demand for our products, with our SSD products achieving record revenue and our auto market revenue also reaching an all-time high. Execution was outstanding, with our industry-leading 1-alpha DRAM and 176-layer NAND technology node ramps delivering strong cost reductions. Our portfolio transformation continues to gain momentum as we lead the industry on the DDR5 transition and grow our mix of NVMe data center SSDs. Following a solid first half, we are on track to deliver record revenue and robust profitability in fiscal 2022 and remain well positioned to create significant shareholder value in fiscal 22 and beyond. We qualified additional products on these advanced nodes with a broad set of customers, which sets us up for continued strong revenue ramp in the second half of the fiscal year. We are tracking several quarters ahead of the industry in ramping products based on these leading-edge process technologies. We are also investing to maintain technology leadership for the next decade and making good progress in the development of future technology nodes. Micron is not only a technology leader, but also the industry leader in quality, with the majority of our customers ranking us number one. Global semiconductor supply chain is experiencing pressure due to impact of Russia's invasion of Ukraine. The region is an important source for the global supply of noble gases and other critical minerals that are used in semiconductor manufacturing. We have strategically diversified our supply chain over the last several years and maintained appropriate inventories of materials and noble gases. We currently do not expect any negative impact to our near-term production volumes because of the Russia-Ukraine war, but we do expect an increase in our costs as we secure supply of certain raw materials that could be at risk. Demand for memory and storage is broad, extending from the data center to the intelligent edge and to a growing diversity of user devices. Memory and storage revenue has outpaced the rest of the semiconductor industry over the last 2 decades, and we expect this trend to continue over the next decade thanks to ongoing advancement of AI, 5G, and EV adoption. Our team's execution on strengthening our product portfolio has been outstanding, with several new product launches and customer qualifications in fiscal Q2. Last year, data center became the largest market for memory and storage, eclipsing the mobile market. Looking ahead, we expect data center demand growth to outpace the broader memory and storage market over the next decade, fueled by secular drivers in cloud and healthy enterprise IT investment. Memory and storage share of server BOM costs already exceeds 40%, and this number is even higher for servers optimized for AI and ML workloads. This growth is supported by new heterogeneous computing architectures, the increase in data-intensive workloads, and the ongoing displacement of HDDs by SSDs. In the fiscal second quarter, data center revenue grew more than 60% year over year, supported by robust demand across our DRAM and SSD portfolio. We have broadened the qualifications for our 1-alpha DRAM products and are well positioned to support the data center DDR5 transition driven by new CPU platforms, which are targeted to begin ramping later this calendar year and gain momentum in 2023. In fiscal Q2, we introduced the 7450, which is the industry's first 176-layer vertically integrated data center NVMe SSD. We expect strong growth of data center SSD revenues to continue for the remainder of this fiscal year. In fiscal Q2, we saw recovery in our client revenue driven by strength in enterprise PCs, which more than offset softer consumer and Chromebook demand. We expect that calendar 22 PC unit sales will be flattish versus last year's sales, but we expect solid growth in DRAM and NAND content, driven in part by increasing mix of content-rich enterprise desktops and laptops. We are leading the industry's client DDR5 transition, and our DDR5 revenue continues to increase as multiple PC customers launch next-generation notebooks. Client DDR5 demand continues to outstrip supply, and we are seeing meaningful price premiums over DDR4 alternatives. Building on our QLC leadership, in fiscal Q2, we also launched our 2400 NVMe SSD, the world's first client SSD built on 176-layer QLC NAND. Micron maintains a leading position in the fast-growing graphics market. We have a broad product portfolio featuring industry-leading product performance and deep partnerships with leading GPU suppliers. In fiscal Q2, revenues grew year over year, driven by strong demand for the latest generation of gaming consoles and graphics cards. Our advanced GDDR6X continues to lead the industry in performance, and in fiscal Q2, we began revenue shipments of our next generation GDDR6X solutions. Fiscal Q2 mobile revenue grew slightly year over year as the 5G transition continues in smartphones. We see some weakness in the China market as the local economy slows, smartphone market share shifts, and some customers take a more prudent approach to inventory management. Mobile memory and storage demand continues to be supported by content-hungry applications and the ongoing transition from 4G to 5G, which is driving 50% higher DRAM content and a doubling of NAND content. 5G smartphone sales are expected to grow to 700 million units in calendar year 22. In fiscal Q2, we achieved the first qualification of our 1-alpha LP5 DRAM, which delivers more than a 15% power improvement over the previous generation, enabling our customers to offer an improved 5G experience with better battery life. We are also seeing a very strong revenue ramp for our 176-layer NAND UFS products, which are now qualified in nearly 50 different OEM platforms. The automotive and industrial segments are expected to be the fastest growing memory and storage markets over the next decade. Today, more than 10% of our revenue comes from these end markets, and we are exceptionally well positioned as a market share leader. In fiscal Q2, our auto revenue set a new record driven by robust demand for memory and storage. Auto unit production remains below demand, constrained by numerous supply chain challenges, including logic and analog semiconductor component shortages. The Russian invasion of Ukraine has also impacted auto builds. Nevertheless, the demand for memory and storage remains strong, driven by auto content growth. New EVs are becoming like data center on wheels, and we expect over 100 new EV models to launch worldwide in this calendar year alone. These new EVs include advanced ADAS and in-vehicle infotainment features that have significantly higher memory and storage requirements. In fact, some of these level 3 autonomous EVs have about $750 in memory and storage content, which is 15 times higher than the average car. In industrial IoT, we saw approximately 60% year-over-year revenue growth, fueled by the continued ramp in applications such as factory automation and security systems. Our expectation for calendar 22 industry demand is largely unchanged from our last earnings call. We expect calendar 22 industry bit demand growth to be in the mid to high teens for DRAM and at approximately 30% for NAND. We anticipate underlying demand in calendar 22 to be led by data center, ongoing adoption of 5G smartphones, and continued strength in automotive and industrial markets. Currently, we see a healthy supply-demand balance across both DRAM and NAND. Given these demand trends, supply discipline across the memory industry, long semiconductor manufacturing equipment lead times, and reduced NAND supply from some of our competitors that experienced a contamination issue in their fab. Non-memory component shortages are improving, and we expect that further improvements should support memory and storage demand growth for the rest of this year. However, there are some pockets where semiconductor shortages have not improved as fast as we had expected, and these shortages are likely to continue into calendar year 2023. Our calendar year 22 bit supply growth for DRAM and NAND remains unchanged from prior expectations and will be in line with industry demand. We are on track to deliver record revenue with solid profitability in fiscal year 22, and we continue to expect strong bit shipment growth in the second half of the fiscal year. However, across the industry, there are cost challenges stemming from supply chain and inflationary pressures, which will limit cost reductions this year for the industry. We remain confident in our long-term technology roadmap and our ability to drive competitive cost reductions for years to come.
Micron delivered excellent fiscal Q2 results marked by record revenues across multiple products and markets, strong profitability, and generation of over $1 billion in free cash flow. I'm particularly excited by the execution of our industry-leading 1-alpha DRAM and 176-layer NAND technology ramp and the accelerating momentum of our product portfolio transformation. Fiscal Q2 revenue was approximately $7.8 billion, up 1% quarter over quarter and up 25% year over year. Revenue was particularly strong in client and cloud markets. Fiscal Q2 DRAM revenue was $5.7 billion, representing 73% of total revenue. DRAM revenue increased 2% quarter over quarter and was up 29% year over year. Sequentially, bit shipments increased in the high single-digit percentage range, while ASPs declined in the mid-single-digit percentage range. Fiscal Q2 NAND revenue was $2 billion, representing 25% of Micron's total revenue. NAND revenue increased 4% quarter over quarter and was up 19% year over year. Sequential bit shipments were flat, and ASPs increased in the mid-single-digit percentage range due to stronger mix of SSDs, more than offsetting like-for-like price declines. Our ongoing portfolio transformation and a solid front-end cost reduction drove sequential gains in gross margin in NAND, despite sequential price declines in most products. Non-GAAP earnings per share in fiscal Q2 were $2.14, down slightly from $2.16 in fiscal Q1 and up more than 100% from the 98 cents in the year-ago quarter. Turning to cash flows and capital spending, we generated $3.6 billion in cash from operations in fiscal Q2, representing 47% of revenue. Net capital spending was $2.6 billion during the quarter. We continue to expect fiscal 2022 CapEx to be in the range of $11 billion to $12 billion, with the CapEx being roughly even between the first and second half of the fiscal year. Our free cash flow for fiscal Q2 was strong at slightly over $1 billion. We remain confident in our ability to generate significant free cash flow in the second half of the fiscal year, substantially higher than that in the first half. We completed share repurchases of $408 million, or approximately 4.8 million shares in the quarter. As we have mentioned before, we will be opportunistic in share repurchases and more aggressive when the shares are trading at larger discounts to intrinsic value. Our board of directors approved a quarterly dividend of 10 cents to be paid on April 26 to shareholders of record on April 11. Our ending fiscal Q2 inventory was $5.4 billion, and average days of inventory for the quarter was 113 days. Our fiscal Q2 DIO increased sequentially due to an increase in raw materials and WIP to support demand for the second fiscal half. Finished goods inventory declined quarter over quarter in both DRAM and NAND. We ended the quarter with $11.9 billion of total cash and investments and $14.4 billion of total liquidity. Our fiscal Q2 total debt was $7.1 billion. Our overall business is tracking ahead of our plans a quarter ago, and demand is strong across most end markets, with some regional challenges that Sanjay referenced earlier. Our improved fiscal year financial outlook is increasing our variable compensation expenses, which will impact our costs in fiscal Q3. We are also seeing cost impacts from continuing inflationary pressures and from supply chain mitigation actions related to industry-wide shortages. Additionally, due to the pull-in of cost reductions in Q2, we expect more modest front-end cost reductions in Q3 on a sequential basis. We do expect both DRAM and NAND gross margins to increase sequentially in fiscal Q3. A higher mix of NAND revenue in our consolidated total will affect our consolidated gross margin, as our DRAM gross margins are substantially higher than our NAND gross margins. We expect revenue to be $8.7 billion plus or minus $200 million, which will represent a new record for quarterly revenues. Gross margin to be in the range of 48% plus or minus 100 basis points, and operating expenses to be approximately $1.05 billion plus or minus $25 million. We expect our non-GAAP tax rate to be approximately 10% for fiscal Q3. Based on a share count of approximately 1.14 billion fully diluted shares, we expect EPS to be $2.46 plus or minus 10 cents. We remain on track to deliver record revenue and solid profitability and free cash flow in fiscal 2022. Revenue growth has significantly outpaced the broader semiconductor industry. Gross margins have averaged over 40% and operating margins have averaged around 30%. Micron's financial foundation and outlook have never been stronger as we build on the momentum created by our portfolio transformation, leadership technology roadmap, and manufacturing excellence.
A strong first half performance and our guidance for an all-time record quarter show our continued progress toward delivering record fiscal 22 revenues and robust profitability. Given our technology leadership, Micron is in an excellent position to capitalize on the broad trends that are driving demand for DRAM and NAND solutions that transform data into better customer experiences and greater business value.